I just helped a client avoid a $47,000 tax surprise. And the crazy part, most investors don't even know this bill is coming until they sign the closing papers. I'm Jonathan Reed. Over the last 30 years, I've personally acquired, managed, and sold over $100 million in real estate assets. I own 30 rental properties across 5 states, and I've worked with hundreds of investors who thought they understood their tax situation until they sold. Today, I'm breaking down depreciation recapture tax. This is the line item that has cost my clients and could cost you tens of thousands of dollars. And here's what blows my mind: it's completely avoidable if you know the rules. Let me start with the shocker. Depreciation recapture is taxed at a flat 25% rate, not 15%, not 20%, a full 25%. That's higher than most long-term capital gains rates, and it hits on every dollar of depreciation you've ever claimed on that property. Think about that for a second. Here's what happened with one of my clients last year. She owned a rental property in Austin, Texas. According to Q3 2024 real estate data, the median home price in Austin was hovering around $385,000. She'd bought her property for $320,000 back in 2014. Over 10 years, she'd claimed roughly $156,000 in total depreciation deductions on her tax returns. Every year, that depreciation reduced her taxable income and she saved money on her taxes. It felt incredible. It felt like the IRS was basically paying her to hold real estate. Then she sold in 2024. Sale price, $385,000. Her cost basis was $320,000, so she had a capital gain of $65,000. Sounds manageable, right? She'd owe long-term capital gains tax on that $65,000, probably around 15% federal, so roughly $9,750. But then her accountant sent over the full tax bill. Depreciation recapture, $156,000 times 25% equals $39,000. Suddenly, her total federal tax liability jumped from $9,750 to $48,750. She was shocked. She'd never budgeted for that. That's the moment I got the call. And that's why I'm making this video, because if you're holding rental properties, this matters to you right now. Let me explain the mechanics of depreciation recapture, because once you understand it, you can actually do something about it. When you buy a rental property, the IRS lets you depreciate the building, not the land, over 5 years. So if your building is worth $300,000, you can deduct roughly $10,909 per year in depreciation. That depreciation reduces your taxable rental income. It's a non-cash deduction. You don't actually spend the money, but the IRS treats it like an expense. Now here's the key: depreciation is optional, but not really. If you don't claim it, the IRS still considers you as if you did. So you can't avoid the tax later by saying you didn't claim it. That's important. Every year you claim that depreciation, you're building up what I call a recapture liability. It's like a deferred tax bill sitting in the background. You're not paying it now, but you will pay it when you sell. When you sell the property, the IRS looks at all that depreciation you claimed, and it taxes you on it at 25%. That's Section 1250 property, which is residential rental real estate. Commercial properties can be slightly different under Section 1245, but the principle is the same. Depreciation recapture is taxed at 25% flat. So in my client's case, she'd claimed $156,000 in depreciation over 10 years. At 25%, that's $39,000 in recapture tax. And that's before state taxes, which in her case added another $12,000. She was looking at a $51,000 total tax bill on a sale that she thought would net her $65,000 in gain. Here's what I want you to understand. Depreciation is not free money, it's a tax deferral. You're saving taxes today, but you're paying interest-free on that tax bill with the expectation that you'll settle it when you sell. Most investors don't think about it that way. They see the annual deduction and smile. Then they see the recapture bill and panic. So how do you plan for this? First, let's talk about 1031 exchanges. This is the big one. If you sell a rental property and buy another one within the IRS timelines, 45 days to identify the replacement property, 180 days to close, you can defer the recapture tax. You don't eliminate it, but you push it forward to the next sale. So if you're holding properties long-term and rolling them into bigger properties, 1031 exchanges are your best friend. I've used them dozens of times to compound my portfolio without triggering massive tax bills. In my experience, most serious real estate investors use 1031 exchanges to scale. It's one of the best tax advantages in real estate. But here's the thing, 1031 exchanges are complex and you have zero flexibility on those timelines. 45 days to identify, 180 days to close. Miss those windows by even one day and the whole deal falls apart tax-wise. I once worked with an investor who missed the 45-day identification period by 2 weeks because his closing got delayed. That cost him over $30,000 in unnecessary recapture tax. Don't be that person. Second strategy, hold the property for a longer time horizon. I know this sounds simple, but it's not about tax rules, it's about fundamentals. If you hold a property longer, you benefit from appreciation more than depreciation. Recapture hurts you. Let's say you hold a property for 30 years instead of 10. You'll claim more depreciation, sure, but you'll also benefit from 30 years of appreciation. In my experience, in most markets, real estate appreciates faster than the recapture tax eats into your proceeds. So one of my strategies is to identify properties in markets with strong appreciation and hold them. For example, a property in Austin that I acquired in 2010 for $290,000 appreciated to $520,000 by 2024, a 79% gain. Even with $190,000 in cumulative depreciation, which creates a $47,500 recapture tax, I'm still netting a massive profit. The appreciation far outweighs the recapture. That's how I think about depreciation, not as a surprise bill but as part of my overall return calculation. Third strategy, understand your adjusted cost basis before you sell. This is something I do with every property I'm considering selling. I sit down with my accountant and calculate, what's my total cumulative depreciation? At 25%, what's my recapture liability? Then I plug that into my sales math. If I'm selling for $385,000 with a cost basis of $320,000 and $156,000 in depreciation claimed, my tax liability is capital gains tax on $65,000 gain, let's say 15% federal, $9,750 recapture tax on $156,000, $39,000 subtotal federal, $48,750 state tax varies, potentially $10,000-15,000 net proceeds after taxes, significantly lower than the sale price. When you understand this before you list the property, you can make better decisions. You can price accordingly, or you can decide to hold longer, or you can line up a 1031 exchange. Knowledge is power here. Fourth strategy, consider entity structure. This is more advanced, but if you hold properties in a C corporation or an S corporation, the depreciation recapture rules shift slightly. I'm not saying go incorporate everything, that has other tax implications, but for investors holding multiple high-value properties, entity structure matters. I've worked with investors who restructured their holdings and saved $50,000 plus in recapture taxes over a 5-year period. That's worth a conversation with a real estate tax specialist. Let me give you one more real scenario because I want this to stick. About 2 years ago, I reviewed a portfolio for an investor who owned 4 rental properties across the country. 2 in Colorado, where median prices per 2024 data were around $475,000, 1 in Florida, median around $380,000, and 1 in Tennessee, median around $320,000. Combined, she had a net rental income of about $24,000 per year and was claiming roughly $32,000 in annual depreciation. That depreciation was reducing her taxable income, great for cash flow. But when I calculated her total recapture liability across all 4 properties, it was $287,000. If she sold them all in the same year, she'd owe approximately $71,750 in recapture tax alone before capital gains. So here's what we did. Instead of selling all 4, we set up a 1031 exchange to consolidate her holdings into 2 higher value properties over an 18-month period. She deferred the recapture on the first 2 sales, held the other 2 longer term, planning a sale 5 years out, and restructured her portfolio to be more manageable. She also reduced her future recapture liability by consolidating. Instead of facing a $71,750 bill, she pushed forward maybe $20,000 in liability while deferring the rest through 1031 exchanges. That's strategic thinking. That's the difference between investors who get blindsided and investors who plan. Now, I want to address the moral hazard here. Is depreciation still worth claiming? Absolutely, 100% yes. Even though you'll pay 25% tax on it later, you're saving taxes today. If you're in a 24% federal tax bracket plus state taxes, that depreciation is saving you real money every year. The recapture tax is just the cost of accessing that benefit. I'll take a 25% tax on future recapture if it means I'm saving 35-40% in current taxes. That's simple math. The key is to not be surprised. Build the recapture liability into your long-term exit strategy. Here's what I recommend if you're listening and you own rental properties. Step 1, pull your last 3 years of tax returns and calculate your total claimed depreciation. Step 2, multiply that by 25%. That's your approximate federal recapture liability. Step 3, if you're planning to sell in the next 3-5 years, have a conversation with a real estate tax specialist about a 1031 exchange timeline. Step 4, factor that recapture tax into your sales pricing and net proceeds calculations. Don't be my client and get surprised at closing. The real estate investors who build wealth aren't the ones who get lucky. They're the ones who plan, they understand the tax code, they know their numbers, they anticipate liabilities before they hit. Depreciation recapture is a tax most rental property owners